Good morning. On behalf of KPCC and Southern California Public Radio, welcome to the Crawford Family Forum. For today's Drucker Business Forum, Economics Plain and Simple, with Marketplace's Paddy Hirsch. Please welcome our host, from the KPCC Business Desk, Ben Bergman.
All right. Well, thank you so much for coming to get a free hour of Economics 101 at KPCC. And we're very honored to be joined by Paddy Hirsch. Let me just give a brief introduction to Paddy. You probably recognize his voice from Marketplace. He is a senior editor there, which he joined Marketplace in 2007. He led Marketplace's financial markets coverage throughout the financial crisis. He was awarded a Knight Fellowship at Stanford in 2010. And you can see him on marketplace.org in his whiteboard videos where he breaks down complex financial issues with little more than a dry erase board and a pen. And prior to becoming a journalist, he served as an officer in the Royal Marines. Might come in handy as an editor at Marketplace. So please welcome Paddy Hirsch.
Yes. Thank you, Ben.
Thank you. And so, Paddy, I want to begin with why you decided to write this book, Man versus Markets.
Well, I was a little short of cash, frankly.
Okay.
Because anyone who's ever written a book knows if you're a little short of cash, a book is not the right thing to do in order to make money.
Yes.
No, the reason was because I had we'd found out during the financial crisis, and this was what really sort of gave birth to the whiteboard series of videos as well, is that people understood about business news in concept. I mean, people would read the newspapers and kind of if they sort of dipped into the business pages now and again, this is sort of general readers, had a vague sense of what was going on in the business world, and you know they had just enough knowledge to make themselves dangerous, right? But what they didn't have was a really deep understanding of what went on in finance. And it became very clear to me when we were covering the financial crisis that while people didn't understand what a credit default swap or a collateralized debt obligation was, well, I mean, who does, right? I mean, they're very extraordinarily complex. It wasn't a surprise that people didn't understand that. But then when we started explaining these things, people would write into us and say, look, I have to be honest, I really don't understand the difference between a stock and a bond. Can you please explain that to me? And I thought, wow, this is really bad. I mean, if people really don't understand these basics in finance, you know, we need to help. And we could have done that in the video series, but we didn't really have enough time or bandwidth. I'd just gone on the fellowship, and I thought, well, why don't we write a book about this? Because it's not. I didn't want it to be a dummies guide, because people aren't dummies, right? Not understanding what a bond is doesn't make you a dummy. It just makes you a human being, because not many people actually use bonds. So if it's not part of your daily life, then why would you necessarily understand them? So I thought, well, this is a good opportunity for me to kind of package all of the stuff that we've done during the financial crisis, but also put in some of the really, really basic stuff that clearly needed. There was clearly a need for explanation of.
The title is rather scary, Man versus Markets. It's not man and markets, and the market is your friend. Yeah. I mean, why is it so adversarial?
Well, so there's a boxer, if anyone's ever seen this book, there's a boxer punching a bull in the mouth. And in fact, the illustrator, initially when he did this, the illustrator was a vegetarian. And he initially, when he did the first draft, the bull had this spit coming out. It was very kind of rocky. And he said, you know, I just wanted to show the meanness of this type of illustration. Anyway, that's kind of an aside. But the reason it's man versus market is because I think a lot of people, especially during the financial crisis, and to an extent now as well, really felt that it was them against the markets, right? I mean, the markets kind of took over the narrative in the news for the best part of a year during the financial crisis. And then afterwards, we wondered to ourselves, you know, how is it that the markets melted down, banks made ferocious amounts of money, and then lost even more money, and we had to bail them out to the tunes of trillions of dollars, and nobody went to jail? I mean, I think when people look at that situation, they think, well, there's no villain here, apparently, so far as the courts are concerned, but clearly there is a villain because, you know, we've lost a lot of our household wealth. And I think that people see that. They look at the markets as kind of a monolith, and they think, well, maybe it is me against it, me against them. But in actual fact, it's not that way, and that's really what the book is laid out to show, is that the markets are actually not that hard to understand. They are not your enemy. In most cases, they are our friend. It's sometimes the people who work in the markets that we need to be worried about.
Well, you also talk a lot about how we always say the markets, but the markets is so many different things.
It is. I mean, a lot of people like to talk about the market because there's more than one market. We have the equity market, We have the bond market. We've got the commodities market. So a lot of different markets that we have that we operate in, and a lot of different markets that you can lose vast amounts of money in, but you can also make money in too, of course.
So we're going to provide a public service today, and Paddy, I want you to say what do you think are the most misunderstood concepts or terms that we hear all the time, and would you please explain them? So give us your top few misunderstood terms.
Well, one of the things that really interests me is the basic stuff. I mean, somebody wrote in the other day and asked and said to us, what's the difference between a bond and a loan, right? And the fact is that a bond is a loan. Okay, a bond is just a bond is just an IOU, and a loan document is just an IOU. It's when the bank writes a note and gives it to you, and it says I owe you, $30,000 or $300,000 or $3 million or whatever it is. A bond is exactly the same thing. You write a bond is written. It's a piece of paper that says you owe somebody a certain amount of money, and you pay a certain interest rate, and it has to be paid back on a certain date. That's all it is. So a bond and a loan are exactly the same thing. And it amazes me, even now, that after all of the talk about bonds and loans and all of the bundling of said instruments into different types of securitizations, blah, 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 that people, a lot of the time, still don't understand the difference between those two. Another one for me is equity and stock. A lot of people, what's the difference between stock and equity? Well, stock and equity is the same thing. And it's just, again, it's interesting to me, because one of the ways that Wall Street kind of pervades the national consciousness and has such a hold on us is because of the language, right? It's the lexicon of Wall Street. A lot of the time, it's really difficult to understand what these people are saying. And if only they spoke in plain English. And frankly, they could speak in plain English. But if you think about it, in whatever business you're in, you probably have your own little, there are probably sort of, analogies that you use in your business. You're probably using certain code in your own business just to make things move more quickly. Everybody in the room knows what you're talking about, so you use the code of the business. The same is for Wall Street. They'll be talking about equity, they'll be talking about debt, whatever it is. They'll be talking about capital structure. And everyone who's not in that business is sitting back going, I have no idea what you just said. But in actual fact, they are speaking, they're speaking English, but they're speaking in their own code. So
part of that to make it seem more fancy. I mean, no one wants to go in and just buy an index fund. It has to be a little complicated to justify higher fees.
Yes, I think so. A lot of the time, bankers will. Well, there are a couple of things. Bankers are more anybody who's in a business is more comfortable talking in the language of their business, right? So that's one thing. However, I do think that a lot of I used to work at Standard & Poor's, and we used to look at these securitization instruments. And it was amazing. You'd go into meetings, and people would talk in this completely incomprehensible language. And you suddenly realize that the reason they were doing that was to make themselves sound really, really smart. And therefore, they were justifying the fees that they were paid or the salary that they were being paid. And I think that there is an element of that. If you sort of create a black art, or you create the impression that there is a black art involved in your business, you can charge more money for it. It's as simple as that. Anyone who's ever worked with, sorry if there's any lawyers in the room here today, anyone who's ever worked with lawyers knows this. I mean, lawyers speak in a completely different language. It is English. It's kind of old English, but 15th century English, I think, a lot of the time. But the reason that they get paid so much is because they understand that language, and the same goes for bankers as well.
What other things do you think are most misunderstood?
Well, I think that the biggest thing that the one thing I think that just blew everybody away was this collateralized debt obligation, which is a securitization. I mean, even now, people are like, okay, so it's kind of like it's been referred to now as bundling securities. So securities are bundled. And then everyone goes, okay, let's move on, because at that point it gets incredibly complicated. So I've got this little analogy that I used. Actually, when I worked at Standard & Poor's and I was training people, sort of teaching them how securitizations worked, back in those days we were using loans. So it was a collateralized loan obligation. So it's just loan is the thing that we have. And you have these things called collateralized mortgage obligations, which are the bundling of mortgages. And really those are at the heart of what went wrong with the financial crisis. So, David, if we can switch to the screen, then I can show you how this works. Okay, we're there. So that's me. This is not me. This is a fund manager. So here's how a securitization, and we'll just say, well, in this we'll call it a collateralized mortgage obligation, which is essentially the same as a CDO, right? So we're talking about CDOs now. And this starts with a manager who says to himself or herself, I want to go and make millions of dollars by investing in mortgages. Now, think about a company, right? A company throws off money every month, right? Every month a company makes money, assuming that it's making money. So what you have there is it's called a revenue stream. So every month a company generates money. Well, if you think about it, every month a mortgage generates money, right? Every month somebody pays their rent, or their interest rate. Frankly, when we talk about rents, we're hearing now about Blackstone, which is starting to securitize leases. So they've got a bunch of houses that they've rented out. Every month, the people who are in those houses pay rent. That's a revenue stream. And the thing is, what you can do with a revenue stream, anything that generates a revenue stream, you can get a whole bunch of them together and create a securitization. Think about a company. Creates this revenue stream. What you can do with the company is you can sell bonds, right? So you have companies that have corporate bonds. And what that is there are investors who have lent money to the company and they expect to be paid an interest rate every month in return for lending those bonds to the company. Well, the same thing goes with a securitization. If you get a bunch of mortgages or a bunch of credit card receivables or student loans or whatever it is, those things are throwing off money every month, and you can take that money and portion it out and give it to people who've lent you money in the first place in order to buy those loans. Let me explain how this works. So here's our fund manager. He's decided he wants to raise $10 million. So he goes out and he speaks to a bunch of investors. And he says, guys, I need $10 million. Can you give me $1 million each or $500,000 each, whatever it is? Oh, my gosh. Okay, this happens all the time. It's a kind of a loose connection, so I'm going to try and hold it in place. So he goes out and he speaks to these investors and he says, give me some money. So they all say, okay, we're a little nervous about this. Some of us are going to take a lot of risk in this investment. Some of us are going to take less risk. More of that in a second. But we're going to give you the money. So he gets the money after his pitch, big bag of $10 million. And what he does is he goes out and he buys $10 million worth of individual mortgages. And he can buy those from a variety of places. Back in 2005, 2006, they were buying them from these individual private mortgage lenders. In some cases, they were buying them from banks. Anybody who was lending, anybody who was writing a mortgage for people like us was then taking those mortgages and selling them off to somebody like this guy, who was then, in the phrase of the day, bundling them. So what he would do, he'd go out and he'd buy these mortgages, okay? And he'd take those mortgages and he'd put them into a bundle. Now, in my bundle is shaped like a bottle of champagne, and there's a reason for that. So it's like, think about a bottle of champagne, right? If you pop the cork on a bottle of champagne after you've shaken it up a little bit, what happens? Yes, exactly. Cork pops out, and all this flood of champagne comes flying out the top. And that's kind of what it's like when you have this bundle of securities, because every month, okay, they pay off money. So the value of what's in the bottle itself suddenly increases because you've got more money in there because people have paid their interest rates. So what happens? The cork pops off the top, and all of that money comes flowing out. Okay, and that money's got to go somewhere. And the place that it goes is into what's called the capital structure of the securitization. All right. Now, I like to think of this capital structure like a pyramid of glasses, like you'd see it's at a glorious mafia wedding. All right. We've all seen those films. I watched The Godfather the other day. It was great, actually. Anyway, so the money flows out into this capital structure. So here it is. We've got this pile of glasses, and we've got this tray that's at the bottom. More of that in a second. Okay. At the top, okay, the first glass, those are the investors that have the people who have chosen that first glass are the people who want to take the least risk. And as we all know, the more risk you take, the more money you get paid, right? So this is the least risky, so it's the highest rated. So in many cases, these got AAA ratings. But there's the least money, okay, that they get paid for this. Okay, so in turn, they invested at this level. They take least risk because they get paid back first, so they get least money. They get the smallest amount of interest, these bondholders. At the bottom, you have the most risky ones. A lot of the time, these are junk rated, BBB and below. And they are the most risky, so the people who've invested at this level get the biggest payments, right? The most interest. And at the bottom, the very bottom, we have this equity. What the equity is, any money that's left over goes to the fund manager and his partners. So they're hoping, of course, that there's lots and lots of money, because what happens is, in good days, the cork pops, the champagne flows through the glasses. The first one gets filled up just like that. Second gets filled up real quickly. The third layer gets filled up pretty fast. The fourth layer gets filled up, and any excess goes into the bottom bucket, which of course goes to the fund manager. And everybody's happy. Everybody's delighted. It's a boom. Everybody's paying their mortgages. Everybody's getting paid. Everyone's happy. Okay, but what happens whenever the recession kicks in? Suddenly, people are getting paid less. Okay. So which means they're less able to pay their mortgages. Suddenly, you've got a lot less money flowing out of that champagne bottle every month. So what happens then? Well, the first glass gets filled up really, really quickly, right? So all of the liquid goes in there first. All the champagne goes in there first. So those people who invested at that level, remember, they get the least interest rate because they're taking the least risk. Why are they taking the least risk? Because if there's less money flowing out, they get paid back first. They get paid back. The second set of glasses, well, they get a little bit. Maybe they get half full. So maybe those guys are getting paid a little bit, but not the whole of the interest they expected. The third and the fourth tiers, they've got nothing, all right, because there's not enough interest to being paid to fill up those glasses. And as for the equity tranche at the bottom, he's completely empty. So your fund manager there is out of luck, okay? Now that's what happens in a securitization, right? That's how a CDO or CMO for mortgages, CLO for loans, or CBO, collateralized bond obligation for bonds. That's how those things work. That's how the securitization works. The problem in the financial crisis was we had these things called CDOs, collateralized debt obligation. Now, all of this stuff is debt. But what they did is they took the bottom level, okay, of these two securities, the bottom ones, the risky ones, and then they repackaged them and put them into another champagne bottle. So now you can see why this stuff was so toxic. These guys at the bottom levels, these investors on the third and the fourth tier, highly unlikely to get paid back in a recession or if people stop paying their mortgages, and yet those formed the basis of the next round of securitization. That was the next champagne bottle. And guess what? The ratings agencies took one look at that and said, okay, it's a securitization, the top glass gets filled, AAA, bam. So even though it was highly unlikely that this bottle was going to produce any income, they still rated the securities AAA. And now you can start to see where we got problems because investors started to buy those AAA securities and then they didn't get paid back, and then everybody was left upset, or as in my parlance, very badly needing a drink at the end of the day. So that's the simplest explanation I can come up with for collateralized debt obligation. I hope that was pretty simple. I know it's an extraordinarily complex instrument. Just to tell you how complex it is, and if anyone's sitting in the audience thinking, oh my God, that's just mind-numbing. Well, let me tell you, almost the entire population of Wall Street's minds were numbed by this securitization instrument. Okay, certainly the ratings agencies' minds were numbed. I mean, we know this because they rated so much of this stuff very, very highly, when in fact it was in fact junk and completely toxic. So believe me, if you don't understand this, you are not alone by any stretch of the imagination. Anyway, so that's my...
But you mean numb because the people who were selling it didn't even know what it was?
Oh yeah, I mean, I think, yeah. I mean, we know, anybody who's read any books about Wall Street, I mean, Michael Lewis's book, Liar's Poker, any of these kinds of books, you know that there are salespeople out there who go into the world to sell securities that they have no real comprehension of. They put a spin on it. They talk a lot of fancy language. They take the person that they're selling to out to lavish lunches and dinners, fill them full of booze, and then and that person buys. And neither the seller nor the buyer, in many cases, knows what they're buying. And if you don't, if you think that this is pie in the sky, think about those Icelandic investment funds that loaded up on this toxic stuff. Loaded up on it. They bought yards of it. And of course, now we all know what happened to Iceland. So, this is not uncommon. This is very, very common, that neither the seller nor the buyer has any idea really what they're selling. They're just told, put lipstick on this pig and go out and flog it to the public. And they do it, and they do it very successfully.
How long, where did these CDOs come from? When did they start being used on Wall Street?
So, CLOs, I started covering CLOs, which is the collateralized loan obligation, right? So this is the loan-based part of this. They came out really in the mid-90s. But frankly, this type of securitization has been around for close to 100 years. Fannie Mae and Freddie Mac were formed, all right, to support the mortgage market. And the way they supported the mortgage market was by buying loans from lenders and then bundling them in exactly this way. So this is not a new thing. What is new is the areas that it's moved into. So it started off with mortgages. It then moved into what they call asset-backed securities, which are things like student loans, car loans, boat loans in some cases, and credit card receivables. So that debt that you owe, if anybody's holding a balance on their credit card, that balance has probably been securitized by someone who's chucked it into one of these kinds of capital structures. So those have been around for a while. It was only this kind of new iteration of corporate loans, which I started to work on in the mid 90s, and then the bundling of these different parts of the security into these CDOs that was actually comparatively new.
So everyone now has seen how dangerous these CDOs are and how they brought down the economy. So I'm sure everything on Wall Street is very different now, right?
Yeah, everything's really changed.
It's all fixed.
Yeah.
But really, I mean, what
nothing
has changed? I mean, are these still, have they learned their lesson at all?
No. Okay. So one of the biggest problems about Wall Street. No. One of the biggest problems about Wall Street is that it is full of really, really smart people. I mean, anybody who knows anything about recruiting at Princeton, Harvard, or any of the Ivies at Stanford knows the pressure on students to go to Wall Street because the money is just so huge. I mean, the attractions are just enormous. I mean, I don't know, whenever sort of generation ago, the thing to go into was maybe to be a doctor, to go into medicine, maybe into law. But now you're not going to make that kind of money in medicine or law these days. You're just going to get sued. You go to Wall Street, clearly you don't get sued, or if you do get sued, you get away with it. Plus, you get paid millions of dollars. I mean, it's a no-brainer. Even now, whenever the profile of investment banking is at its lowest ebb in terms of popularity. I mean, bankers are not popular, but still, almost 50% of the graduating class in Princeton will go to Wall Street this year. I mean, the lure is just immense. And the fact is that there's a brain drain to Wall Street where they've got our best and brightest. A guy who I knew very well, he has a degree in aeronautical physics. Okay, he then got a PhD in physics. He went to Wall Street and he created securitization instruments for Credit Suisse First Boston back in the day. I mean, that's the kind of talent they're attracting. So it means that these guys are innovating in in securities business far faster than Wall Street has ever innovated before. They're coming up with these incredible ideas that can make money. And the regulators and the government just can't keep up, simply cannot keep up. I mean, the Securities and Exchange Commission, even the Federal Reserve, all of these regulators, the CFTC, they're back in the 80s still. Wall Street is a decade ahead. So they're so far behind. So in a way, it's not that the government or the regulators don't want to learn their lesson. They just can't move that quickly. They just can't move as fast. So what they do is they put these blocks up, right? So they put these barriers up. And there are things like, forcing banks to keep more money, more skin in the game, right? Keep forcing banks to keep more money on their balance sheets to compensate for any of the risks that they're taking. So if things go pear-shaped, then they've got lots of money there that they can draw on. So they put these barriers up, but then Wall Street goes out and recruits guys who find a way around the barriers. I mean, they're really smart. So in a way, we have learned the lesson, but we don't have the tools to put those corrections in place that can actually consolidate those lessons.
And is that partly because of the moral hazard question? Banks feel like they can fail and they'll just be bailed out, so why not gamble?
Of course, you speak to a banker, any banker will tell you, oh, no, there's no moral hazard, absolutely not, But I think absolutely. I mean, if you're a banker, I mean, I think that to be real, the people at the heads of these banks, the Jamie Dimons, the Lloyd Blankfeins, I think they really believe that moral hazard is a bad thing. I think they really believe that they can operate independently and without needing government support, and they won't take those risks. And I think that they genuinely want to put the restrictions and the structures in place in the banks to prevent their banks from failing. But then that doesn't account for the rogue traders, right? It doesn't account for the division of, in securitization that's doing something crazy and has been given kind of sort of skunk works license to do something to make money. And then they start making money. And it's very, very difficult for the CEOs of those banks to say stop. Firstly, because the banks are so big that the CEOs don't even know what's going on in that division. But secondly, because the revenues are so enormous, they're making so much money. And anyone who's looked at bank earnings in the last couple of quarters knows that the banks are having problems making money. I mean, they make money, but to generate profit, they're having problems there. So I think it's very, very difficult for the CEOs to actually.
And why is that? Why are they having trouble making money now?
They're having problems making money because they can't lend, right? Because, I mean, I hate to be an apologist for the banks, but the banks are in kind of a difficult position right now. On the one hand, they've got the government saying, lend money because we need to get the economy moving again. We need to have, cash flowing through the economy and making everybody healthy again. But on the other hand, they've got the government saying, oh, don't take any risks. Don't take too many. If you start lending people who aren't going to pay the money back, we're not going to bail you out. So they're in this kind of which way do I go? And what they've done generally is they've become more conservative. So they're not taking risks. Companies aren't taking risks. So there's less lending going on, and there's much less kind of I guess innovation going on around the edges. I mean, if we have time, we can talk about these things. Credit default swaps, which were part of the financial crisis as well. Those things have gone away now. They used to make huge amounts of money, but they're sort of dwindling. That business is now disappearing. You know, they're not able to make as much money on trading now because of the high frequency trading, where it's very, very difficult to make a lot of money on the margin. So you know, banks are, I mean, don't get me wrong, they're still doing okay, but they are having a much more difficulty making money than they did in the past.
So that sounds like something that has changed, right, for the better?
That's what.
Well, not from the perspective of the banks.
Do you have a 403b bank? Yeah, I mean, this is interesting because you know we live in a shareholder economy. All right, we depend on people like the banks to make money because we're invested in the banks, whether directly or indirectly through our 401ks or 403bs. So we want the banks to do well, but at the same time, we don't want them to do too well, right? We don't want them to do so well that they're actually, putting risk on us. So yes, that has changed in the last sort of the boom years for the banks between, say, 2002 and 2007. We're not seeing those kind of boom years, but I think that those were an aberration anyway. I mean, people talk about banking being a utility. It used to be if you were a banker, yes, it was a relatively easy business to do. You made loans, you collected interest, but that wasn't a huge money-making business. So I think we're in a way what we're doing is we're reverting to the norm when it comes to banking.
Well, and you talked a little bit about how the banks have changed. How has what you've done changed, and how you cover business and the economy at Marketplace? Well,
it's become very difficult for us because you guys are a lot smarter now. I mean, we used to be able to get away with, I wasn't at Marketplace at this time. But no, it's true. I mean, back in the day, it used to be that people had a good working, like I say, a basic working knowledge of how business worked, and we were able to kind of pay lip service to that. We'd say, here's what's going on in business, the stock market's doing this, gold price is here, here's an interesting story about a business that's doing something kind of crazy on the side. The financial crisis changed all of that. People are way, way smarter about finance now. People are much more invested in the way that their money works and how the relationship between government and Wall Street works. So it's much more difficult for us to cover the news now. And it's much more challenging in a good way. It means it's raised our standards. We have to explain things much better than we used to, and much more comprehensively than we used to. We have to be much more inventive about the way that we approach business topics because people can see through just a kind of a piece of peripheral coverage. We've got to be much more incisive, and we've got to be much more in depth. So it's made the business more challenging, but it's made it a lot more interesting too, frankly.
And I mean, describe a little bit about what it was like sitting in the New York Bureau of Marketplace when this was all going down and trying to go on the radio and explain what was happening. I mean, we barely understand what happened 5 years later. So day of, how did you possibly do that?
Well, we're fortunate because Marketplace attracts tremendously talented reporters. They are really, really smart people. And I remember, the Bureau, I used to call it the AAA Bureau because we had 3 women in there, all with the first letter A and in their names, Ashley, Amy, and Elisa. And these women were all general assignment reporters, all right? They did everything. They'd cover technology, they'd cover fashion, films, bit of Wall Street, this and that. But suddenly they had to become absolutely immersed in Wall Street. And I can remember, I'd be on the phone. I was fortunate that I came from Wall Street, so I understood how a lot of this stuff worked. I would be on the phone, we'd be on the phone for an hour and a half, just breaking this stuff down. And these women were able to take the explanation that I gave, find people who could speak to that on the phone, and then in 2 hours, 2 or 3 hours, produce a 90-second news report that basically did its very best to elucidate this. And in most cases, I think that they succeeded. I mean, we weren't great initially, but once they got into the groove of it, they got really good. I remember Jeremy Hobson, when he moved to the Bureau, he arrived the week before AIG collapsed, and he rang me, I think it was a Sunday night, and he says, I can't get into the Bureau. I was here in Los Angeles. He says, I can't get into the Bureau. I'm standing in the foyer of the US Bank. It's raining outside. Can you brief me on what AIG does and what's happened here? I'd been out to dinner and I'd had a couple of glasses of wine, but anyway. So I briefed him on this, and it was incredible. The next morning, I woke up and listened to this report, and it was a 60-second report, and it absolutely nailed it. It was lucid. It broke it down. The clarity was amazing, and I think that was the exciting part, was seeing how truly talented our reporters were, and how they were able to just, spin, wool into gold very, very quickly, just based on their own instincts. That was the exciting part for me.
Well, and Marketplace, every day you guys do the numbers and either play the happy music or the sad music. And we see a lot of emphasis on the numbers and the markets and the stock market. I mean, does the stock market actually tell us anything about how the economy is doing?
No.
No. Okay. So why do we care?
Yeah.
Aside from our 401ks.
Well, and even then, you shouldn't really care, right?
Okay.
I mean, was it John Bogle who said, at Vanguard, who said, you should put your money in your 401k and leave it for a year and then check it, maybe move it around, then leave it for another year. I mean, do the Warren Buffett thing and file and forget. Okay, don't forget completely.
Don't be a day trader.
Yes. So no, that's a really interesting question, and we've been. It's interesting that it's been our mantra for the last year at Marketplace, is that the stock market is not the economy. They are two very, very different things. And in fact, I'll do a little drawing here, if I can make this thing work. Dave, can we switch to the screen? That'd be all right. So if you look at the Dow Jones Industrials, okay, it looks a lot like this, right? It's been woohoo, and I had a bit of a down here, but it's been like this. We've had this incredible last 18 months in the Dow. It's been great, but this is the economy. All right. So you can see if you know anything about the economy, and the economy is the economy of real people, right? How much people are getting paid, whether or not people are getting re-employed, how many jobs people are working. In some cases, 3 jobs. How many of those new jobs that we hear created each month are part-time? A great number of them. The fact is, the economy is still bumping along, whereas the stock market is going great guns. So the stock market is not a true reflection of the economy. Most people, when they talk about the stock market, say that the stock market is an indicator of what the economy could be in 6 months. Okay, so the people who are speculating in the economy, and let's be honest, they are speculating. It's a speculation like any other, like buying gold or buying Bitcoin, whatever. This is it's a lot more scientific than investing in Bitcoin, obviously. I mean, you're doing good investment on public, or good due diligence on public companies where there is real information. But it's a projection on where the stock market is going to be, or where the economy is going to be in 6 months. How is this company going to be performing in 6 months? It's going to be performing really well. Okay, I'll invest my money in it. If you think about the way that people who are investing in anything think about that investment, you can see that it's a projection of future earnings. But you don't put your money into something that you don't think is going to earn money in the future. You put your money in it because you think it's going to give you a return. So hence, that's a projection of what's going to be going on in the next 6 to 12 months. So that's the basic reason of why the stock market's not the economy. But the other reason is because stock markets are companies, economies are people. Okay, stock markets reflect how companies are doing, and companies are doing very, very well. Why are they doing well? Because they're squeezing workers like crazy. They're laying people off, and they're cranking productivity on workers to rates that we've never seen before. So they're getting a lot of money out of the individual worker, and they're having to pay fewer of those workers in order to get that stuff done. And what are they doing with that money? They're not reinvesting it in the economy. They're not hiring more people. They're stuffing it into their bank accounts. Companies are richer in terms of their cash flow, in terms of their sort of cash volume, the amount of money that they have in their own personal banks, than they've ever been before. It's incredible how wealthy these individual companies are. So when you're looking at them as an investor, you're like, wow, this company looks really, really healthy. Then you look at the economy, and you see all these people still laid off, people still struggling to get jobs, people still working 2 or 3 jobs to get by, and you think, oh, the economy is not so healthy. So there's a real disconnect between the stock market and the economy right now.
But when you're hearing every day either the stock market is doing really well or really poorly, can that actually have an effect on how the economy is doing in terms of the psyche?
Yeah, absolutely. I mean, we hear about these consumer confidence numbers all the time, right? Consumers feel good, so they're going to go out and spend. And yes, there's this thing called the wealth effect, right? When people see the wealth effect has everything to do with assets, right? If you are invested in the stock market, or you own a house in America today, your assets are rising, right? The value of those assets are increasing. The stock market's going up, so your shares are worth more. The property market's going up, so the value of your house is worth more. So if you're invested, that's great. You're going to feel wealthier. Maybe you'll go out and spend more money, okay? But less than 50% of Americans are invested in the stock market. Fewer than even, and that includes through retirement plans. Fewer than 50% of Americans are seeing those gains. And fewer than 50% of, fewer than 60% of Americans, fewer than 2/3 of Americans own their own homes, even marginally. And less than 20% of Americans own those homes outright. So that it means that whilst we're seeing this rise in asset prices, the vast majority of Americans are not actually seeing those gains. So whilst there is a wealth effect and consumers are going to feel wealthier and maybe spend more money, the only people that are going to do that are the people who are seeing their assets rise in value. So yes, there can be a connection between the two, but we're not seeing it in the way that we need to see it today, which is why the government is so adamant about trying to get more people into homes.
So what do you think are the important metrics to follow in terms of knowing the strength of the economy?
Well, I think the jobs number is the big one. And I'm not alone in that. I mean, that's what the Federal Reserve will tell you as well. They look at jobs and inflation. They want to see, and when I say jobs, I'm not talking about the jobs number that we hear, we're nearly at 6.5% now. That's not the number we should be looking at. We should be looking at this other number. It's the U6 number, which tells us it's a much wider picture of employment. It talks about, how many people are, out of work and looking for work, out of work and not looking for work, who's dropped off the rolls. Those are the kinds of numbers we should be looking at. And when you look at that, it looks as though employment is a lot higher, maybe 10%. It is coming down, to be sure, but it's still much higher. And that's one reason why, we've heard of this quantitative easing thing, and we can explain that if we want to, but this government program where they're going out and buying huge amounts of bonds. The reason they're doing that, the reason they're still doing that, and they haven't slowed it down that much, even though they said that they'd stop doing it when we hit a 6.5% unemployment rate, is because that 6.5% unemployment rate is not real. That's not a real rate. And that's why we're still buying those bonds and still seeing the stimulus in the economy. So I think that long-term unemployment number, the U6 number, is really the important one to look at.
Okay. Well, I have lots more questions, but I also want to open it up to our audience in case you have questions for Paddy about anything we've talked about or anything else. Although I have one caveat: please do not ask any personal investment questions. Paddy said he gets that we're not being paid nearly enough to be able to give financial advice. So, but anything else, please let us know. And also, I believe we have microphones, right? So wait for Janice to come to you so that the people at home will hear you. And so Janice, do you want to pick someone to ask the first question?
Hi, I'm Karen. I was wondering the events that are happening in the Ukraine, how they're going to affect the economy and the stock market?
I don't. That's a great question. I mean, that's the question of the day, right? I actually don't think that much. So, unless obviously there is a full-on war, okay, clearly that would be something. But I don't think that that's going to happen, for one thing. And so let's talk about what would be affected. So the three things that we're starting to see move right now in terms of the way that they affect Americans are the price of oil, the price of wheat, and the price of corn. Okay, there's gold as well, but that's all kind of an aside. And none of those are moving. So, I mean, the price of all of those things is up right now, and that always happens. It always happens when there's tension in that part of the world. We're not that dependent on Russia for natural gas, even though they're the world's largest producer, because we produce just gut loads of our own natural gas, which is great. So I think that as far as the U.S. is concerned, the price of wheat and the price of corn could affect. They could affect the price of food eventually, but the price rises have not been that big, and the market has not been skewed that much. So I don't think we're going to see much there. As for the stock market, well, I mean, ours barely moved. The Russian stock market dropped precipitously initially, but then it came back up 5% the next day. So even investors in Russia feel pretty reassured about things. So I think that while there is cause for concern there, I don't think we're going to really see it hit America. One of the really interesting things about it is this kind of brinkmanship between Europe and Russia. Russia's got this incredible leverage over Europe because it supplies so much of its natural gas. And Germany in particular, which is trying to wean itself off nuclear power and is looking at alternative energies, again, really interested in natural gas. So Germany, probably the strongest political player in Europe, and therefore the most persuasive arguer with the Americans, is going to be playing Putin's card in many ways, I think. So I think that, I don't know how this is going to resolve itself. It could get nasty in the future, but I think that, I don't think it's going to happen imminently, and I don't think the US economy will be badly affected. Short answer.
Just a short question. Could you please tell me why U6 numbers don't get reported every few days, as opposed to the standard unemployment rate?
They're getting reported more and more. I think that it's the Bureau of Labor Statistics puts out this number, and it puts out this data sheet, and all the data's in there. And I actually think it's just laziness on behalf of journalists. Journalists could quite easily just say, this is one number and this is the other number, just to provide context. But they don't. We do, generally. But if you're just going to read the New York Times, just the front page, or the Washington Post on the front page, or even the LA Times on the front page, that's the number that they broadcast, as opposed to putting it in context and saying, well, in actual fact. I think more and more journalists are doing that now because they understand, in particular, what the Federal Reserve is looking at. But I think it requires more due diligence on their part. And the number's easy to find. You can go to just bls.gov. It's right there for you to see it. But yeah, it should be reported. There should be more context in reporting. Absolutely.
Yes, I wonder if you could explain something. It should be fairly simple, but I don't understand it, although I've studied economics. And that is the fact that the stock price of many companies keeps advancing, even though they pay little or no dividends. Now, the expectation of investing in something, it would seem to me, is sooner or later you're going to get some dividend result. But many companies, as I say, pay zero dividends or extremely low dividends. I mean, a good, I don't know if you want to call it speculator or not, like Tesla, for example, is selling at 138 times price to earning ratio. A home builder in this area, Lyons Homes, their stock price increased from $10 to $30 a share in the last year. They pay no dividends. They're a solid company, been in existence for over 50 years. When did the dividends come, and why, if the dividends aren't coming now, it would seem to me as soon as there's a problem in the economy, the price of these stocks drops precipitously, adversely affecting the economy.
So does everybody understand what a dividend is? Everybody know what a dividend is? Okay, I'm just going to explain it really quickly. So a dividend is when a company has lots and lots of money and it decides to return some of that money to the shareholders. But if you're a shareholder, generally you don't expect to get any money back until you sell your shares, all right? You sell your investment in the company. But many companies in this country, in fact around the world, pay this thing called a dividend, which is that once a quarter they will pay a certain amount of money to the shareholders. That if you own one share, you'll get a certain amount of money. So multiply those shares, you get a certain payment, right? So they return some of the money that they've got in their their wealth bucket back to individual investors. So that means there are two reasons for investing in a company, right? The first reason is because you might get this dividend every quarter, which for a lot of people who are on fixed incomes is a really smart to do. So a lot of older people, when they're investing, look for dividends that are going to pay them a monthly income stream, which is great, because unlike bonds, which you'll see variation in the amount that you get paid every month, with these stocks you just get paid the same amount. It doesn't change. So that's one great reason for investing in shares. The other great reason for investing in shares is because, unlike a bond, which only pays you a certain amount over a certain period and then you get your money back, the upside on shares is enormous. I mean, you could buy a share at $1, and at the end of the year, that share could be worth $8,000, conceivably. So there's no end to the potential upside in equity in shares. And I think the answer to your question is that a lot of companies play that game. They say, we're not interested in giving money back to shareholders. The message that we're sending is, shareholders, we're taking that money that we've got in our coffers and we're reinvesting it in our company to make it even more profitable, so that eventually, and reinvesting it again and again and again, so that your money is going to be worth so much more in the future. And whether or not that's a specious argument, I don't know. There are many people who now make the argument that companies that pay dividends are poorly run companies. That if you have cash, you should actually be reinvesting it in your company, hiring more people, growing, buying other companies, as opposed to doing the lazy thing and returning that money to shareholders. Now, obviously, people who are interested in dividends aren't going to agree with that, but I think that's the tension in that argument, and you're seeing it in a lot of early stage companies like Tesla these days.
But then you have Apple, who's just sitting on all this cash,
Sure.
doing nothing with it.
Yeah, which I think it's actually beginning to irritate a lot of their investors. I mean, I'm reading a lot of research notes now where people are like, why isn't, Apple's got so much money, why hasn't it produced the next big thing, the Apple shoe, whatever, I don't know, whatever it is. Why haven't they done that? Where's the innovation? If it's got that much money, shouldn't it be doing something incredibly innovative as opposed to just returning money to shareholders? Where's the real value in that? And, it's an interesting argument.
Or they could buy Tesla, which is
they could buy Tesla,
a
yeah.
little bit.
Say my name? My name is Mike Sanders. I'd like to ask what your feeling is with regard to the potential replacement of the dollar as the world currency and how that would affect financial markets.
Well, the first thing is I don't think that's going to happen. I mean, it's what's going to replace it? The euro? I don't think so. The ruble? I mean, the Russians were last week saying, yeah, we're going to. I mean, it's just no. It may happen eventually. I don't think it's going to happen tomorrow. Is it? How big a deal is it? It's interesting. I mean, depending on who you talk to, people get very freaked out about this. There are a great number of advantages to being the world's reserve currency. There's a lot of demand for your currency, which means it keeps it high, which has a lot of advantages. Of course, there are a lot of disadvantages to having a very valuable currency. There are a lot of advantages to being able to transact in your own currency anywhere in the world. I mean, if you're Chinese, for example, it's very difficult to do business in your own currency. You've got to do business in dollars. So it's great to be the world's to be the reserve currency because everybody wants your money, everybody wants your dollars. I think that if the dollar was no longer the world's currency, you'd see the dollar would fall in value. But that could help us in many ways. I mean, many people would say that's a good thing. Aside from that, though, it would make business more difficult for us, but not that much more difficult. I mean, we're just talking about a conversion issue. I mean, what's the most successful economy in the world right now? Is maybe Germany, right? Which doesn't have the US dollar. It uses euros. It has to convert. It's talked about. There's been some talk in Germany about going back to the Deutschmark because they want to get away from the euro. So you get an even smaller currency. So I don't necessarily think that not having the world's reserve currency is going to sort of plunge us into a depression or anything like that. I mean, it would be mildly inconvenient for a period, but we'd get over it.
Hi, you made the comment that it seems that, in your opinion, banking is reverting to a long-term norm, but I have to say that I don't really see that. As examples, it's been demonstrated that the large banks fix interest rates. There was the entire LIBOR scandal. It's been demonstrated that they launder Mexican and Colombian drug money, and so those are legal issues on the high end. On the low end, every single one of these liar loans and ninja loans that were made was also a violation of the law. And so it seems to me that millions of laws are violated, nobody's gone to jail, and that there are two legal systems, one in effect for us and one in effect for the banking system. And so it doesn't seem to me that there's any sort of return to a long-term norm. I was wondering if you could comment on that.
Well, when I say a return to the long-term norm, I'm talking about the bank's ability to generate profits, not necessarily about the bank's return to honesty. I'm not entirely sure that the banks ever were that honest in the first place, right? I mean, a bank is made up of individuals, some of whom will be corrupt. I mean, it's as simple as that. And this is nothing new. I mean, if you want to, you can go back to the days of Jesus and the moneylenders in the temple, if you fancy. I mean, the savings and loan crisis is a good example. I mean, there have been banking scandals for as long as banks have existed. The BCCI is another classic. I mean, the list is endless. So I'm not sure that there's that. So let's go to this second part of the question, which is there's one law for the banks and one law for everybody else. I think that it's unfortunate that we have a political system that is as vulnerable to capital as it is. It means that the bank lobby is extraordinarily powerful in Washington, D.C., and I think it means that enforcement of the laws that do exist, and I think those laws do exist, and I'm not entirely sure that, and clearly individual extension of liar loans and ninja loans in some cases were illegal, but in many cases they weren't illegal.
Can you explain what that is?
Yeah, so the liar loan was, all you had to do was to sign a piece of paper saying, I earn a certain amount of money every year, and you didn't have to provide proof of income. You just got the loan. They were like, okay, well done. And they just gave you the loan. And of course, they didn't. The company that lent you that money, didn't hold that loan. It then sold it to some guy who put it in one of these champagne bottles, and that's where it all went horribly wrong. But unfortunately, that wasn't illegal. That was actually legal. That's the terrible thing. It was actually legal. And what had happened is that the regulatory framework that originally had made those things illegal, or might have made those things illegal in the past, has slowly been stripped away by the power of the banking lobby, which wanted as much freedom as possible to do whatever it wanted to do. And of course, Congress, because they're so beholden to money and to these special interest groups, agree. They say, oh yeah, well yes, we'll just wave that through, we'll wave that through, we'll wave that through. So over a period of sort of 10, 15 years, you had the system where our regulatory system was either dismantled or weakened, or completely or left unenforced by like a stripped down SEC, Federal Reserve, Office of Thrift Supervision. All of these guys were basically denuded in terms of their ability to actually enforce the laws or try to create a more vibrant framework. So I don't think actually there is one law for them and one law for us. It's the same law. Unfortunately, it's not a good law. It's a bad law. Now, and I'm not saying that we should have more regulation. I'm saying we should have better regulation. But it's very, very difficult to create a good regulatory framework and basically revamp the regulatory framework with a political system that we have. And we look at the Dodd-Frank Act. Okay, it started out as like this little sort of sheaf of paper. It's ended up like this. It's got so many loopholes, you could drive a Chieftain tank through it. It's outrageous. But that's the way our system works. And unfortunately, until we change that system, we're gonna the problems that we have are gonna persist. So your next question might be, so does this mean we're just gonna have another crisis? The answer is probably yes. We probably will have another financial crisis. We don't know, it's probably not gonna be exactly the same as the last one, but it's almost a guarantee that we're in for another crisis because we're not ready. We're never ready in this country because we don't, and in many ways that's a good thing. We don't have this heavy hand of regulation holding everybody down. It's not like China, but it's in many ways it's too light, and it means that people can skate and get away with things as they did in the banking, they have done in the banking system all the time.
My question is, how does someone such as the people in this room know whether you have a good champagne bottle or a toxic one?
Well, hopefully you've got a bunch of smart guys in the regulatory in the ratings agencies who are actually looking into what's in the bottle. So, and that's how you know. And then they will rate those securities accordingly. Like they'll look at it and they'll say, what they should have done is looked at these things and said, oh my gosh, there's no way these things are going to pay out. This top screen here is junk. It's BBB minus. It's a C. But they didn't do that. They just went, and stamped it. And actually, in many ways, what they did was they said, wow, if we don't rate this really, really highly, we're not going to get paid. Because the way the rating, if people didn't know this, the way the rating agencies get paid is they get paid by the companies that they rate. So there's always always tension there, right? It's a complete conflict of interest. So the company being rated or the organization being rated might say, hey, if you don't give us a good rating, we're not actually going to go with you guys. We're going to go with Moody's or Fitch or one of these unheard. So it's in their interests, you might say, to juice the ratings. And many people said that that's exactly what happened. I think actually what happened in this case is they didn't even think about juicing the ratings. They just rubber stamped it. See, which is in a way even worse. They didn't even squeeze more money out of the deal, which is stupid. Say again?
How do we protect ourselves then?
Well, you could say we changed the ratings agency business. But here's what really is the case is when most a good investment company that's going to be, so for example, you yourself would probably not buy one of these toxic assets, right? But you're one of these toxic glasses, okay? But you're the company that that invests in your 401k that you've chosen to put your money with might. Your hope is that the manager of that company, of that fund manager, will go and actually do his own or her own due diligence. And good companies do that. But too many companies just rely on the ratings agencies. You know, they say, oh, if the ratings agency says it's worth AAA, it must be true, as opposed to actually going in there and doing some real work and saying, actually, which is what a number of people did in the financial crisis. And you had you know, a number of bankers who made a name for themselves by saying, there's no way this is right. And they made a completely opposite call. And as a result, they made a lot of money for them and for their investors. There's a gentleman at the back here, I think was.
Oh, thanks. I have a question for you. In the Chinese economy in the last few decades has gone from pretty much a zero footprint on the world stage to a very large integral part of the world stage. And in the olden days, it used to be like a tripod of Japan, Europe, or the US, each holding up the world economy. With China becoming a more important part of that, the fact that their financial system is, everything I read, it seems to be, it's almost like a house of cards, even compared to ours. Are they setting the world up for a problem the first time there's a little pinprick in the Chinese economy and their financial system won't be able to handle it? Because it seems like you already see little anecdotal evidence of that in companies that try to get cash or this and that in China, and it's Wild West how they do things. Yet it's such a large economy. It kind of makes me nervous. I'm just wondering what you think.
Yeah, I think it's true. There are a lot of people in, I mean, anyone who's, I've known, I mean, I used to work, my career my journalism career started in Hong Kong. So I know, I've a lot of sort of long-term connection with China. And I knew guys back then who were like, there's just no way you'd want to invest in China. Just the legal system is impenetrable. It's completely corrupt. You've got to pay off all of these people to get anything done. You have no idea what the financial system is going to look like in 5 years. I speak to those guys now, they're like, there's just no way you'd want to invest in China. The legal system is, I mean, nothing has changed, really, nothing has changed. So investors are saying that about, I mean, some people are taking big risks, obviously. You know, people, I mean, Taiwan is slightly different, but which is where Apple has its fab factories. But, you know, the fab factories or the manufacturing factories in China, the American companies have, those are big risks that they're taking because they have no idea what's going to happen you know, legally with the government. I mean, the government can do whatever it wants, right? There's nothing to stop the Chinese government. And if there was, they would just tear that rule up and, you know, throw and burn it. That's just the way that they work. But in a way, that's their strength when it comes to the financial system. So if you say to yourself, well, China's obviously very, very important. It is, depending on where you look at it, the largest manufacturing economy in the world right now. It's certainly the largest market in the world, which is why, you know, we're so careful about our relationship with it because it buys so much of our stuff. Right, it's very, very important to us, those buyers. And they're only going to get wealthier and they're only going to want to buy more, which is only going to benefit us more. So yes, if something terrible happens in the Chinese financial markets, it could be a real problem for us. And they're really very dysfunctional right now. I mean, you hear a lot about these things, this whole thing called the shadow market, which is where you have lenders who are completely unregulated lending to companies at like these incredible interest rates, you know, like, you know, 80% interest rates. So, but that's where a lot of the money in China, where a lot of businesses in China get their money from. So it's a really odd financial system. But here's the thing about China. If it thinks something's going wrong, it just grips it. It just jumps on top of it and just hammers it down. And then you've got complete government control. That just can't happen in America. Can't happen in Britain, can't happen in Europe. It just wouldn't happen here because of the way that our laws are constructed. The government just can't do that. In China, they can do whatever the heck they want. And in many ways, that helps us because it makes it, in a way, more stable. It makes it much less certain, and certainly not a great place to do business in if you're worried about uncertainty. But in a way, that kind of certainty of whether or not the economy is going to survive, in a way, it makes it more certain. So it's kind of an ironic situation there, I think.
Hi. Do you speak about the signing away of the GlassSteagall Act by Bill Clinton and the impact it had on the collapse of the U.S. economy in your book?
A little bit, yes, I do. So yeah, so GlassSteagall was an act that was put together in the 1930s by Mr. Glass and Mr. Steagall. I think Mr. Steagall they were senators. Anyway, so they created this act that separated the business of retail banking and investment banking. For those of you, and this is all in the book, but retail banking is the business of making loans to individuals and taking deposits. Right, that's basic retail banking, like what Bank of America used to do. Checking deposits, all that stuff. Investment banking is the business of creating securities for companies, like helping them sell bonds, helping them with their sort of cross-border transaction, helping them buy other companies. The business is basically helping corporations. And Mr. Glass and Mr. Steagall said it's a good idea for us to separate these two businesses, because if you had one bank doing all of this business, what happens if they made a big bet on the commercial side with a company and things went really badly wrong? Well, then they'd have to use the money, depositors' money, to pay for that. So they said that wouldn't be a good thing, right? That wouldn't be a smart thing. So let's separate those two businesses. Now, what happened was in the 1980s, banks like Citibank in particular, and Citibank's kind of the poster child for this, got so big and was doing so many other types of business. It was doing insurance, it bought travelers, it started to sort of dabble in, through its foreign acquisitions, in investment banking. And eventually then it bought Salomon Smith Barney, which was a broker, and it tried to keep this, what they call a Chinese wall between the two. So it's like we have these two businesses, but they're not really the same. And they kind of bled into the GlassSteagall area. And they were so successful and so profitable that everybody in Washington, D.C. went, wow, this is a real cash cow. We can't shoot this. And then Bank of America got into it, and J.P. Morgan got into it, and Chase Manhattan Bank got into it. And then it was unstoppable. So Bill Clinton signed the repeal of the GlassSteagall Act, allowing the consolidation of these two types of banking business. Now, of course, what we have is too big to fail. We have these enormous banks, these just behemoths that do all of this business. They do insurance, they do personal banking, they do investment banking, they do commodities, they do all this stuff. And as a result, people are concerned that will have what happened during the financial crisis, was they'll make a big bet, which will drag the whole bank down and drag the whole financial system down. So people say, maybe we should bring GlassSteagall back. And maybe we should, but it would be an extremely difficult thing for us to do. And the biggest, just logistically very difficult, but the biggest argument against it, which is made in Washington, D.C., and I'm not sure I entirely agree with this, is that it would make us very, very uncompetitive, because we'd be up against banks like HSBC, Hong Kong Shanghai Banking Corporation, against Deutsche Bank, against Credit Lyonnais, against Credit Suisse, or UBS. All of these banks do exactly this type of work. They're huge banks. They do all of this business. They make vast amounts of money for their country, or individual countries, and they're extremely competitive at that level. If we split banks off so that they couldn't do both of this kinds of business, the argument goes, then we would be less competitive in a global marketplace. Whether that's true or not, I don't know. Goldman Sachs, remember, made itself a retail bank in order to take advantage of the Fed's lending policies. During the financial crisis, it said, we don't want to be an investment bank anymore, we want to be a retail bank. So they became a retail bank, and then they became an investment bank again. Goldman Sachs is pretty profitable, okay? Goldman Sachs is doing okay. So I actually think that bringing back GlassSteagall is actually not a bad idea, personally. But you need to get that thing through Congress first, and believe me, those guys are bought and paid for, so I don't think it's going to happen anytime soon.
All right, well, we should probably wrap up and let everyone get to work, but thank you so much for coming. Thank you to Janice, who produced this program, and also to John, who's sitting there in the back, who runs the Crawford Family Forum. We thank all of you for coming, and if you're not already a member of KPCC, please consider becoming one so that we can continue to bring you programs like this for free. And thank you so much for Paddy. The book is Man versus Markets. It's a great book, highly recommend it. And it's available in the front, and you can hear Paddy on Marketplace every day at 3 and 6:30 here on KPCC, and follow him on the Marketplace whiteboard. So thank you so much for coming, and thank you, Paddy.
Thanks for the great questions. Thank you.